Every month, you send your mortgage payment into the void, and the CRA doesn't care one bit. But there's a CRA-approved strategy that lets Canadian homeowners convert that non-deductible mortgage interest into a tax deduction while building an investment portfolio at the same time. It's called the Smith Manoeuvre, and most Canadians have never heard of it. The Smith Manoeuvre was developed by financial planner Fraser Smith and laid out in his book of the same name. The core idea is debt recycling. You're not taking on more debt, you're changing the type of debt you carry. Here's the logic. Mortgage interest in Canada is not tax deductible, but interest on money borrowed to invest is, according to the CRA's own guidelines on interest deductibility. The Smith Manoeuvre uses a readvanceable mortgage, a specific mortgage product that includes a built-in HELOC, to borrow money as you pay down your principal, then invest that borrowed money in income-producing assets. The borrowed to invest interest? Tax deductible. Before we go further, I put together a free 2026 Canadian Money Moves checklist that covers strategies exactly like this one. Link in the description. Here's the actual mechanism, step by step. 1. You make your regular mortgage payment. A portion of that, your principal repayment, reduces what you owe on the mortgage. 2. Because your mortgage is readvanceable, that freed up equity is immediately reborrowed through the attached HELOC. 3. That HELOC money gets invested, typically in a diversified portfolio of Canadian dividend ETFs or broad market ETFs through a platform like Questrade or Wealthsimple. 4. Those investments generate returns and dividends. 5. At tax time, the interest you paid on that HELOC is claimed as a deduction, generating a refund. 6. That refund goes straight back to the mortgage principal, accelerating the cycle. Rinse. Repeat. Every month, your non-deductible mortgage debt shrinks and your deductible investment debt grows. Let's look at actual numbers. Assume a $600,000 mortgage, a 5% interest rate, and a $2,000 per month payment. In a standard scenario, roughly $500 a month in the early years goes to principal. Under the Smith Manoeuvre, that $500 gets reborrowed and invested each month. At a 7% average annual return, consistent with broad market ETF historical averages, that $500 monthly investment compounds to roughly $405,000 over 25 years. Here's the actual number on the tax side. If your marginal tax rate is 40% and you're paying 5% interest on a $100,000 HELOC, that's $5,000 in interest, generating a $2,000 tax refund annually. That refund goes back to the mortgage. The math says same mortgage, same payments, but you end the 25 years with a $400,000 plus investment portfolio you otherwise wouldn't have. Now, the Smith Manoeuvre is not a free lunch, and most people who get into trouble with it skip this part. Risk 1. You are investing borrowed money. If markets drop 30% and your portfolio tanks, you still owe the HELOC. Your debt doesn't shrink with your portfolio. That's called leverage risk, and it's real. Risk 2. Interest rate changes. If your HELOC rate climbs, your deductible interest cost goes up, which sounds fine on paper until cash flow gets tight. Risk 3. The strategy only works if the CRA deductibility conditions are met. The borrowed money must go directly into income-producing investments, not a TFSA, not a savings account, not your kids' hockey fees. A common mistake is mixing HELOC funds. You need a dedicated investment account, clean paper trail, and ideally a tax professional who knows the Smith Manoeuvre. The structure matters as much as the math. Here's the practical question. Can you actually do this? First, you need a readvanceable mortgage, a product that automatically readvances your HELOC as you pay down principal. Several major Canadian lenders offer these products, so ask your mortgage broker specifically for a readvanceable structure. Second, you need at least 20% equity in your home. That's the minimum to access a HELOC in Canada. Third, your income needs to support the carrying cost of both the mortgage and the HELOC interest payments without stretching your cash flow too thin. Fourth, and this is important, you should not be doing this inside a TFSA. The CRA's deductibility rule requires the borrowed money to flow into a taxable, non-registered investment account. The TFSA is incredible for other reasons, but it breaks the deductibility chain here. If you're using an RRSP, similar issue. Contributions must come from earned income, not borrowed funds under this structure and non-registered account only. If you're starting the Smith Maneuver, your investment account matters. You need a non-registered taxable account, and both Wealthsimple and Questrade let you open one with no commission on ETF purchases, which keeps your costs low as you drip money in each month. Links to both are in the description. The Smith Maneuver isn't for everyone, but for Canadian homeowners with stable income and a long time horizon, the math is hard to ignore. Free 2026 Canadian Money Moves checklist? It covers the Smith Maneuver setup steps and other Canadian strategies worth stacking this year. Link in the description. Follow the Gain channel for weekly Canadian money breakdowns.